Hi there, I'm Suk Day. I'm a chartered accountant and an MBA. Organizations face a wide range of risks that can impact on the outcome of their operations. Enterprise risk management involves the identification, assessment, and then putting in place risk response strategies to reduce the level of risk or uncertainty to a tolerable level. In this tutorial, I will discuss the key components of an enterprise risk management framework and its application by a UK-listed company. What I've listed here are the topics that we will discuss in this tutorial. The first topic is the key elements of an enterprise risk management framework. How an organization deals with its business risk will affect a company's valuation. The 2018 UK Corporate Governance Code requires listed companies in the UK to implement continuous process for identifying, evaluating, and managing the significant business risk the organization faces in any operating year. All listed companies in the UK Stock Exchange have to report on its risk management process in their annual report to the shareholders. The Enterprise Risk Management Framework is a framework to assist organizations effectively identify, assess, and manage risk. The key elements are 1. Identifying business risk, 2. Undertake a risk assessment, 3. Formulate risk responses, 4. Monitor and control of risk. In the next slide, we'll look at how an organization identifies business risk. Risk management starts with the identification of risk. Risk identification requires a thorough knowledge of the organization's strategy, its products or services and markets, and the legal, social, political, and economic and technological environment in which it exists. Methods of identifying risk within the organization would be to start or establish risk workshops, stakeholder consultations, scenario or what-if analysis. Finally, using a risk identification and classification frameworks. There are many frameworks that can be used for risk identification. Two common frameworks are the SWOT, Strength, Weakness, Opportunities and Threats, and PESTLE, Political, Economic, Social and Cultural, Technological, Legal and Environmental Analysis. PESTLE analysis is a technique used to understand the impact of outside factors on an organization. It allows an organization to understand the big picture of the environment they are situated in. SWOT analysis involves stating the objective of the organization and identifying the internal and external strengths that are either supportive or unfavorable to achieving that objective. The framework I will discuss in this tutorial is called the Frame Risk Scorecard, which classifies business risk into the following categories: financial risk, infrastructure risk or operational risk, reputational risk, and finally, marketplace risks. In the following slides, we will discuss the classification of business risk using the Firm Risk Scorecard. The first classification is financial risk. Risks that can impact the way in which money is managed and profitably is achieved. These are regarded as internal risks. Examples of such financial risk are changes in exchange rates, and this can reduce receivables and increase expenses. Changes in interest rates can increase the cost of borrowings and reduce profitability. Changes in commodity prices can increase input cost and reduce the margins. Credit risk, default by customers because of poor credit control. Fraud, which can lead to financial loss. Capital expenditure decisions gone wrong. Weak cash flow. And finally, high leverage or high levels of debt. The next classification of risk that we're going to look at is infrastructure risk, which are also sometimes regarded as operational risk. Risk that impact the level of efficiency and dysfunction within the core processes of an organization. For example, information systems, purchase systems, sales systems, wages systems, etc. Examples of infrastructure risk are supply chain disruptions, natural disasters, example flooding, non-compliance with health, safety and environmental regulations, breaches in information technology or systems by hackers, breaches of anti-bribery and corruption policy, loss of key staff, failure of IT systems, loss of data, product liability, and finally inventory obsolescence. The next risk we're going to look at is reputational risks. Risk that damage an entity's reputation as a result of failure to manage other risks, for example, infrastructure and marketplace risk. The other final risk category is marketplace risk, risks that impact the level of customer demand, and examples are competitor actions, geopolitical events. Geopolitical events are political developments that change the economic and operating environment. And finally, the organization's reliance on a few customers. Risk assessment is the next step after risk identification. Risk assessment requires consideration of the following two factors: the likelihood or probability of the risk event occurring, and this can be from unlikely to highly likely. The magnitude of the financial impact of the risk event on the company's operation, and this could be from minor to catastrophic. These two factors are used to create a risk matrix or risk map to provide a visual representation of risk. This gives rise to four risk scenarios. First one is low likelihood and low magnitude, low risk. Number two is high likelihood and low magnitude, medium risk. Low likelihood and high magnitude, medium risk. And the last category is high likelihood and high magnitude, which is high risk. The principal business risks identified by the entity can then be placed on the relevant quadrant on the risk map to get a visual representation of that risk. In the following slides, we will look at how risk is identified and risk is assessed at Hunting plc. Risk identification at Hunting plc. Hunting plc is a premium listed company quoted on the London Stock Exchange and is a constituent of the FTSE All-Share Index. Hunting plc is a key supplier to the upstream oil and gas industry. Hunting plc has identified 8 principal risks it faces as a business in 2020. This risk, using the risk classification scorecard, can be categorized into financial risk, infrastructure risk, reputational risk, and marketplace risk. We'll first look at the financial risk, and the first risk, or risk number 1, is commodity prices of oil and gas will remain depressed, and as a consequence there will be less oil and gas exploration. This will impact Hunting plc's revenue, as the company is a key supplier of goods and services to the oil and gas drilling companies. The next classification is infrastructure risk, and in this category we have risk 6, loss of key executives. Key executives are senior management who possess commercial, engineering, technical, and financial skills that are critical to the success of the business. Also in this category is risk 5, health and safety and environment, HSC risk. For example, a potential accident resulting in a personal injury, a breach of HSC regulations, the rise of unexpected compliance expenditure whenever law or regulation is renewed or enhanced. The other two categories in the firm risk scorecard are reputational risk and marketplace risk. Reputational risk arises from the failure to manage, for example, infrastructure and marketplace risk. Marketplace risk, which affects the customer's demand for the company's products. Risk 2, competition, including advancements in alternative energy sources which compete with oil and gas sources. Risk 3, shale drilling in the United States. If there is a decline in shale drilling activity in the United States, this can impact the demand for the company's products. And finally, risk 4, geopolitical risk. The location of the group's operations are determined by the location of Hunting's customers' drilling sites, and some of the locations are in very volatile environment. In this slide, we will look at risk assessment. The 8 principal risks identified by the Hunting plc are then assessed in terms of probability of occurrence and financial impact using the risk matrix or map. The risk matrix also shows the movement of this risk during the operating year. High risk, which is the high probability and high financial impact, are changes in commodity prices, U.S. shale drilling activity, and geopolitical events. These are externally driven risk. Medium risk, low probability and high financial impact. In this category, we have the health, safety, and environmental risk. These are internally driven risk. And finally, we have the low risk, which is high probability and low financial impact. And in this category, we have the loss of key executives and the deterioration in product quality. Both these risks remain unchanged from last year. The third step in the risk management process is risk response. This is the process of selecting and implementing measures to manage the risk. There are 4 ways to manage the business risk. First is tolerate, will be the main response for the low likelihood and low impact risk. Tolerating risk or risk acceptance is where no action is taken to mitigate or reduce the risk. Treat will be the main dominant response for high likelihood and low impact risk. Treating risk is taking mitigating action to reduce its occurrence and financial impact. Transfer will be the main dominant response for high impact and low likelihood risk. Risk transfer is the assignment of a risk to a third party using a legal agreement, for example, insurance. Terminate will be the dominant response for high impact and high likelihood risk. Action is taken to halt the activities giving rise to the risk. In practice, the risk response suggested by the risk matrix may not be appropriate. For example, if high likelihood and high impact risks are embedded within mission-critical activities, for example, entering new markets, they may be unavoidable. In this case, it will not be possible for the organizer to terminate those risks. Rather, it will require a different risk response, such as treat or risk mitigation. For example, when entering new markets where there are considerable geopolitical risk, the organization may do it in partnership with a local company. Organizations will need to take a risk-by-risk approach when deciding how to respond to a risk, i.e. the choice of response will depend on issues such as the organization's strategic objectives, its risk appetite, the likelihood and the financial impact of the risk, and the cost and benefits of the mitigation plans. In the following slides, we will consider the risk response measures Hunting plc has implemented to deal with the 8 principal business risks it had identified. Risk 1. Commodity prices, which is oil and gas, will remain depressed, and as a consequence there will be less oil and gas exploration. This will impact Hunting plc's revenue, as the company is a key supplier of goods and services to the oil and gas drilling companies. Mitigating action or risk responses taken to minimize risk 1, which is to treat or reduce the risk, would be, for example, monitor working capital and inventory levels, monitor closely market reports on current and forecast activity levels in the oil sector, reduce production costs and develop new technologies, including automation and robotics, that help mitigate the impact of any future downturn for further downturn in commodity prices in the future. Risk 2 is competitive pressures, including advancements in alternative energy sources. Risk responses or mitigating action taken to minimize risk 2. 1. The company has a number of high specification proprietary products that offer operational advantages to its customers. Product innovation, i.e. it invests in research and development that enables it to provide technological advancement and widen its product portfolio. Competes on quality, not on price. Hunting's operations are established close to their markets, which enable the group to offer reduced lead times and a focused product range appropriate for each region. Monitoring of competitors' pricing and product offering. Develop customer relationship management, regular communications and sharing of information with customers to enhance peer-to-peer relationship. Widen its customer base so that no one customer represents an overly significant proportion of group revenue. And finally, diversification. The group is widening its product range, offering beyond the oil and gas market. Risk 3 is there is a decline in shale drilling activity in the US, which can impact on the demand for the company's products. A decline in shale drilling can occur due to lower worldwide commodity prices for oil and gas. This risk has a high probability of occurrence and a high financial impact. Risk responses or mitigating actions taken to minimize risk 3. The board monitors rig counts and general completion activities within the U.S. shale industry. Local management maintains an ongoing dialogue with key customers operating within the U.S. market. The group maintains a diverse portfolio of products that extends beyond supplying the shale drilling industry, including products for conventional drilling and the manufacture of high precision and advanced technology components for both the onshore and offshore markets. Finally, many of the group's facilities have the flexibility to reconfigure their manufacturing process to meet changes in the pattern of demand. Risk 4. Geopolitical risk. The location of the group's operations are determined by the location of Hunting's customers' drilling sites. Some of these locations are in volatile environments. Risk responses or mitigating action taken to minimize risk 4. 1. Areas exposed to high political risk are noted by the board and are strategically avoided. Global sanctions are also closely monitored with compliance procedures in place to ensure Hunting avoids high-risk countries or partners. Finally, the board and management closely monitor projected economic trends in order to match capacity to regional demand. Risk 5. Health, safety and environmental risk. And examples of a HSE risk that we had discussed earlier could be the occurrence of an accident resulting in personal injury, the financial risk of a breach of HSE regulations, and the risk of unexpected compliance expenditure whenever law or regulation is renewed or enhanced. In 2020, HSE risk escalated during the year due to COVID-19, which impacted all the company's operations. Risk responses or mitigation action taken to minimize risk 5. 1. The board targets achieving a record of nil incidents and full compliance with laws and regulations in each jurisdiction in which the group operates. Every group facility is overseen by a health and safety officer with a responsibility for ensuring compliance with current and newly issued HSE standards. The group facilities have rescheduled work patterns and reconfigured unit layouts to enable appropriate social distancing measures, and staff have been encouraged to work from home where this is possible. Risk 6 is the possible loss of key executives or senior management who are critical to the success of the group. Risk response or mitigating action taken would be 1. Remuneration packages are regularly reviewed to ensure that key executives are remunerated in line with the market rates. External consultants are engaged to provide guidance on best practice. Senior management regularly reviews the availability of the necessary skills within the group and seeks to engage suitable staff where they feel there is vulnerability. Employee feedback is encouraged and an employee engagement survey has been undertaken in the year. Risk 7 is product quality. A failure of any one of the group's products could adversely affect the group's reputation and demand for the group's entire range of products and services. Risk response. 1. Quality assurance standards are monitored, measured and regulated within the group under the authority of the Quality Assurance Director, who reports directly to the Chief Executive. The final stage of the risk management framework is monitoring and control of risk. In the next slide, we'll consider how risks are monitored and controlled in organizations. Monitoring and control of risk. There is a hierarchical structure involved in the monitoring and control of risk, as the Stobart Group Risk Management Framework attached shows. The key components in the monitoring and control of risk are the Group Board, which has overall responsibility for the risk management and application of control. This includes reviewing the robustness of the risk management internal controls so that they remain fit for purpose. The Corporate Risk Register records strategic, operational and financial risk across the business. This register incorporates risk likelihood and impact to assess an overall risk rating and prioritize mitigating actions. The oversight of the risk management process rests with the Audit Committee. It receives and reviews information relating to this principal risk, together with details of action taken and relevant mitigating controls prior to advising the board in this regard. Internal audit reviews specific risk and controls delegated to it by the Audit Committee. Direct ownership of risk management within the group lies with senior management teams and divisional CEOs.